Good afternoon, everyone. Thank you for joining Early Stage VCs. What are they really thinking? A SheWorx Roundtable conversation with Charlie O'Donnell and Michelle Dhansinghani. SheWorx is a member of the Republic family focused on bridging the gap between female founders and funders. We are a strong and growing network of women entrepreneurs who are shaping the future of tech and investing. So with some quick housekeeping items, you are all on mute for the presentation portion of this section. If you have questions or comments, please pop them into the Q&A section. We are also recording the event, and the recording will be available in the coming weeks on the SheWorx website and through our newsletter. And of course, the necessary disclaimer. This session is for educational and discussion purposes only, so the views expressed during this webinar are held by the individual participants and not necessarily their employers. So for the next 45 minutes, we will be joined by Charlie O'Donnell of Brooklyn Bridge Ventures and Michelle Dhansinghani, a Tory Burch Fellow and an MBA candidate at Columbia Business School. Charlie and Michelle, thank you very much for joining us. And Michelle, I'll let you take the stage from here.
Yeah, thank you so much for that introduction. I'm really excited to be with everyone and really excited just to have a conversation with Charlie. And like Veda kind of shared, I'm currently an MBA at Columbia Business School and also a venture associate at Laconia Capital. But to just kick things off, would love to kind of like just talk to Charlie a little bit and set the stage. So Charlie, could you tell us a little bit about yourself, your background? I think you have a really interesting background because you've been both a founder and a funder, and you've seen things from both sides of the table. But would love to learn about who you are and like what brought you to VC.
Yeah, sure. So I would say I have been on a couple of different sides of the table. I started my career funding VCs. So people don't really think about where VCs get their capital from, but most VCs basically get the capital they invest from either larger institutions like endowments or foundations, sometimes corporates, occasionally high net worth individuals. And so I was at the General Motors Pension Fund, which had been a long time investor in the asset class, literally since like the late 70s, early 80s, and invested in sort of all the top tier funds that you can think of, and got a pitch in 2004 for a New York-based venture capital fund. And if you could sort of, for those who were sort of involved in the industry at that time, in 2004, venture capital was largely dominated by Silicon Valley, and Boston was another area, but like that was basically where most of the venture capital formation was. The idea of doing a New York-based venture capital fund in 2004 seemed like a terrifically stupid idea to most people. Now we are very happily the second largest venture capital community in the world. And so it's very exciting to be a part of this community. I wound up joining that fund who pitched us. So I was the first analyst at Union Square Ventures, which has gone on to become a very successful fund. I did dabble a little bit in entrepreneurship, starting a company unsuccessfully. So for anybody who has gone through failure, know that the person you're pitching, at least when you pitch me, has not necessarily done a better job at it than you have. And after working at First Round Capital, helping them open their New York office in New York, I started my own firm. So I guess I'm a second-time founder in the fact that I've founded this venture capital firm. And I will say that the opinions expressed by me are, in fact, the opinions of my employer, because I am the only person on the investment team at Brooklyn Bridge Ventures. So I can say that I do reflect my employer in this situation.
So as someone who has gone on to raise funds from LPs, has founded, now has their own venture fund, why did you decide to start your own venture fund? Like what was kind of the process behind that? And then if you could just give some insight for folks who are also thinking of raising their own funds, And if you have any insight also on rolling funds, I think that's like the sexy thing right now. That would be really helpful.
Yeah, sure. So look, the goal with venture capital is to be a partner. You want to be a partner because you want the autonomy, you want the economic upside, and the reality is that like partnership opportunities, aren't necessarily there aren't many of them, right? There just aren't very many venture capital firms in general, and there's not a lot of turnover, right? You look at a lot of the partners at venture capital firms, and they've been doing this for a long time, right? If they are doing this job for 5, 10, 15, 20 years, there just aren't very many openings that come up in any given year. And so if you're going to create an opportunity for yourself, starting a firm is one way to do it. So, if you happen to have been investing somewhere, get a little bit of a track record, you might want to break out on your own, because that's where the partnership opportunity is. As it was, I was at First Round Capital. They had 4 partners. They had 3 principal level people. It was a small fund. There just weren't a lot of openings. And just specific to me, in all honesty, I'm not a great team player. I like making decisions on my own. First Round in particular was very much a team-oriented firm. We had to get 3 out of 4 votes to approve a deal. And that's not the environment where I thrive in. I do very, very early stage investing, probably some of the earliest bets in New York, pre-product. And sometimes it's just really hard to convince a room full of people to back a company that is pre-product or pre-revenue or is missing some folks on the team. So this solo GP thing was just a better fit for me. As to the rolling funds, I'll admit that like I was sort of already out of the gate with my funds before rolling funds, came out. But what I will say though is that the thing you have to be careful with different flavors of venture is that some of these new iterations make it easier for people to come in, but it also in some ways makes them a little less committed. So for example, if you are doing SPVs or AngelList syndicates or something like that, right? The first 5 deals you do could hit a wall and not be great. And if that's the case, how many people are going to be around for the 6th, right? By raising a more traditional fund like I did, where the investors are committed for 3 or 4 years during the investment period, it could be that the fund returning IPO company is the 25th deal that I've done, and my investors are stuck with me for the first 24. And so, look, these are very high risk deals. Lots of them don't make it. And so for me, I wanted the benefit of knowing that I have 3 or 4 years to find those limited handful of companies that are going to make it. And so rolling funds or syndicates might be good to get started, but you want consistent sources of capital, and that's not always what those things bring. So it's kind of trade-off.
Yeah, I think that we often hear just all of the pros about rolling funds, but we don't hear a lot of kind of the cons. And thinking about it in a more strategic way, I think that's a really interesting way to think about that. And I've heard a lot of folks around audio. Hopefully this helps.
Well, this is much better. This is
okay.
Yeah.
I look like a gamer now, so I think there's an opportunity there. But so one of the things that I also am really interested, not only like we've heard about your background, we've heard about kind of why you decided to start your own fund, but now, like, can you talk a little bit about your investment thesis and where you decided to, like, what that like thought process looked like, and why you decided to deploy capital in those spaces?
Yeah, sure. So there's basically 2 types of investors, right? Opportunistic and thematic. So there are some people who say, look, I'm the world's leading expert on AI, and I have a strategic advantage and network when it comes to doing stuff in the AI space. And there are other people, which is the camp that I fall in, that is just like, hey, if somebody smart comes along and convinces me that they have something in an interesting space, I'll take a look at it, regardless of space. Now, I think that stage is where people probably stay most consistent. So while I am a generalist in the sense that I don't necessarily follow along a particular sector, given the stage that I invest in, when it's 2 people in a prototype or 3 people and 3 customers or what have you, most of those companies are going through the same things, right? They're just trying to figure out, who do we need to hire? How do we not run out of money? Where do we spend our limited marketing dollars and get the best ROI? What's the next round investor going to ask of us? And those things are really consistent across the board. So the way I sort of think about it is, I leave it to the founders to be the expert on their space, right? And maybe I think about this a little differently, and it could seem riskier, but I think you sort of have to be careful about what you believe is a risk and whether you where you're taking them. There are 3 types of founders, right? The first division among founders are founders who are smart and not smart. That's an easy division, right? There's some people that just really, really impress you, and other people where you're like, I don't know if I want to back this person. That's easy to tell the difference, right? In the smart category, because we're only backing sort of smart founders, there's people who have done their homework and done enough homework, and people who haven't. That is a much more tricky division, because there are some people who they are really smart and they present super well, but they have an idea and they really haven't kicked the tires on it yet. They really haven't done nearly as much work. And sometimes it's because, it sounds like a good idea and they have a great network of people. So maybe they are able to raise a friends and family round or an angel round or something, without people making them go through all the necessary work involved and really make sure they have something. And so if I feel like a founder has really done their homework and has gone through all of those necessary steps, I'm inclined to trust the founder's view of an industry, because I tend to think that rational, smart people would not want to be stuck in a bad idea, right? So if you have gone in, if you've been doing nothing but spending the last 6 to 12 months talking to everybody in the space, clearly iterating an idea, and you can walk me through, hey, we tried this thing, we shared it with clients, here's the feedback, here's what we learned, here's how we realized that everybody else in the space is going the wrong way, this is the insight, all of this sort of stuff, right? I'm inclined to believe that the conversations they had with those customers were legitimate, right? That like, if I trust that they've had those conversations, I don't try and do over in a really, really small amount of time. It very, very much frustrates me when you go and pitch an investor and somebody's been working on something for like a year and they're clearly knee deep in it. They run a newsletter on that space with 10,000 people on it, right? And you got this VC who's like Googling around for potential competitors, doing this really cursory search going, well, what about these guys? It's like, well, yeah, no, I know those people. It's not like what we do at all. You've literally been Googling for 3 minutes. That's like, I've been in this for 12 months. That's not at all what we're doing. And so if you trust that the entrepreneur's gotten past that point, I think you're at the point where you need to be able to take a risk on this person. So I'm more of a early stage generalist, and also I'm focused geographically. Like, as a solo GP, I'm in a very big market. New York is not particularly competitive when it comes to venture capital investments. There's plenty for me to do here. I get into nearly all of the deals I try and get into. And so it's more than enough for me to look at. And there are plenty of great ecosystems out there. You've heard some buzz about different places. There's some VCs and successful entrepreneurs that tweet as if they're the first ones to think of moving to Miami from New York during the winter. I'm 100% sure that's been invented already, and those people will be back in April. But you know, it's an ecosystem that I'm focused on as far as New York.
Yeah, no, that makes a lot of sense. I think that even, especially at such an early stage of entrepreneurship, you're thinking seed, Series A, like, you really don't have a lot of historicals to go after, right? You have gut, you have good team, understanding founders, and it seems like that's really at the core of what you're looking at. And I'm going to change, kind of shift the conversation a little bit, and just to set the stage, right? I know that you are someone that lives and breathes startup trends. However, the world as we know it has changed forever, right? The way that we learn, the way that we connect, and the way that we shop, just to name a few things, have changed. And so in this, we're seeing massive industry revolutions. So can you tell us a little bit of like what sectors you find industry interesting that are not fads but are here to stay in terms of opportunities for investment?
Yeah, so it's funny because I am talking to a company now that if I wind up making an investment would be the third consecutive healthcare deal I've worked on. And I am, again, like I'm a generalist. I'm just taking what comes down the pipeline. I think what tends to happen is um, there's a period of time that it just takes to sort of develop your idea. And so it's not surprising to me that after, I mean, we're still in the pandemic, but after the pandemic has started and people start thinking about disruptive ideas, that there's certainly a lot more focus on healthcare and people's relationships to healthcare and all of that sort of stuff. So I'm seeing a lot of that. And I think it's something that, look, not only during the pandemic, but even politically, there was a lot more focus about coverage and access and who has it and who doesn't and all of this sort of stuff. That's, you know, smart people are focused on that. I would say the other thing is sort of a general theme. I'm not a social impact fund, but I see a theme where some of the best quality people want to make a positive impact on the world. That, you know, no knock on anybody doing ad tech, but it just seems to me former ad tech people that are like, you know, that's not a space I'm necessarily as excited to be in anymore, about using people's data to sell them more stuff and, you know, whatever. And oh, by the way, that serves a useful function in society. I've bought plenty of random stuff over Instagram, and I like it when I get well-targeted ads versus bad ones, right? So I'm not knocking it, but there's a lot of people who are, especially after the last 4 years, focused on how do I leave the world a better place? And so they're focused on issues of access, um, you know, like I said, health, you know, quality in products, sustainability, all of that sort of stuff. And so I've seen a lot of stuff. Like one of the companies I backed is enabling people who are in debt to take more agency over negotiating their debt instead of being preyed upon by debt consolidators and negotiators and all of that sort of stuff, to be able to help themselves out of that problem. And clearly that's a huge, huge problem. So it's a fintech founder that isn't just looking to like help investment banks make more money, but is taking that from a really individual centric point of view. So it is funny that some of my investors will look at the deals that I've done in these funds and say, is this a social impact fund? It's like, no, I'm here to make money, but some of the best people that I'm running into are looking to make money in positive ways, in ways that, you know, you can feel proud to be an investor in this company.
Yeah, I just took a class on the psychology and economics of consumer finance, and we were looking at different financial products. And one of the CEOs that we spoke to was the CEO of Betterment, that I think has really empowered people to have control over their money and build wealth. And then we also looked at more traditional products like payday lending. Still both profitable companies, but different ways of making money. And so I think that you're definitely onto something. And so in the past, I know that you've been an early supporter of and have helped source many startups that have made it big, such as GroupMe or Moat and Refinery 29. Where do you go against the grain? And like, what is the thing that like where do you see that specialness in these companies?
I mean, like, sorry, just to be more clear, like, how do I, what stands out, in other words, or I think it's different for every company. One of the ways I think about my portfolio is not that it's the ones that stood out, although maybe you shouldn't tell this to them, but they're almost like who's left over from the ones that definitely won't work. Or to think about them in a very complimentary way. I think it was like Michelangelo or whatever, who used to say, well, I take a block of wood and or a block of marble and I chip away all the things that aren't the statue, and then I'm left with the statue. And that's the way I sort of think about it, where I say, okay, let me start at the top of the funnel with a bunch of smart people who've done their homework. And let me chip away at spaces that are too small or problematic plans where, they're just not raising enough money for this thing, or they're not being ambitious enough about their goals, or just targeting the wrong market, any which way, things that you don't like, right? And then I ask, well, does this team's skill set match the challenges of this particular idea? So for example, and this is an example I use all the time, I should probably come up with a different one, selling to small businesses. If you have some tool that, for example, enables restaurants to make better deliveries, right? Selling into a pizzeria is very different than selling security software into the CIO of Morgan Stanley. That is a completely different sale. It requires a completely different set of experiences. And so if you're coming to me as a team of technical founders who have never done this kind of sale, nobody on the team has ever worked for Yelp or Yext or Single Platform or Seamless or one of these types of places, they've never seen it. It's hard to get back to get behind that team, because that is a unique sale. Oftentimes, it's not the technology that wins in that space, but the efficiency of the sales. Whereas on the other side, if somebody's building a consumer product and it's, former hedge fund people, design and product iteration and user experience, like those are key skills that you need to iterate, right? Exactly, how, like somewhere along the lines, the lead product builders behind Snapchat had to decide, like, how long before this photo should disappear, and what's the interface for getting connected to friends and searching friends and all of that sort of stuff. And it's like a million decisions that went into creating a successful product, and you need that design and user experience sensibility on that team. So it depends on what that particular startup is generating. And in the case, like, you brought up Moat. In no way was I an expert on anything that Moat was doing at the time. That was a scenario whereby the former founders of Right Media were getting together for their next big thing, and they had sold their prior company for like $780 million. And without even knowing what they were up to, I immediately called the other partners at First Round and was like, we have to get in that deal. Like, because these are people that know their space. They have no reason. I mean, they have generational wealth. They don't even have a reason to work again. They're up and doing their next thing in the space. So it's clearly an opportunity, right? And you want to back those folks. That's not most startups, right? Like, that's not a bet that I would get if I tried to start something That's not a bet that most of the people here in the audience would get. Like, if Jack Dorsey was starting another company, or if Katrina Lake from Stitch Fix was starting another company, like, most of us would write that check without even knowing what it was, but that's not most of us. So that's not, kind of realistic.
So I guess kind of like now moving into more of like a founder focus. So you invested in Wethos after meeting founder Rachel Ronock at a SheWorx pitch event.
Yes.
And you've talked about kind of like spaces where you've worked with folks in the past, but like what made you work and invest in Rachel and her company?
Oh man, I mean, Rachel made me. I mean, that's one where, and this is where I think you have to be careful about this concept of like great founders, because not every founder runs their company the same, and not every founder's like the thing that might make me a good investor, if it turns out I am a good investor, we'll see over the long term, is maybe different than what makes somebody else a good investor, right? And I think the same thing with founders. So Rachel has a lot of qualities that I admire. She is incredibly straightforward. She is tenacious. She is a great listener and quick learner, and just really iterates, very fast. And so I felt like she was somebody that I could work with. I felt like she was sharp in identifying a need. But where she's been successful is that, Wethos as a company has gone through a few different iterations. She sort of, tacked and turned and, changed the sales a little bit sort of over time, to find product market fit and to find a sort of scalable version of that business. And so, should she win out in the end, it'll be very easy for me to say, oh, clearly it was her tenaciousness that led her to that success. But I know plenty of tenacious founders that didn't make it, right? So it's not, it's not provable. It's not to say that anybody who fails isn't tenacious, but all of those things sort of have to kind of come together, I think, is what I'm saying. Like I could, people say this thing, well, you're backing the founder, you're backing the team, that's most important. There have been some teams that I've really liked, that I just thought were working on the complete wrong thing. And I have literally said the words, I would back you probably to do just about anything but this thing. And I have to pass because I just can't. You don't want an investor who is not behind your idea. They should be open-minded enough to know that like this idea will iterate and change. But particularly me, and I'm very outspoken, you don't want me sitting around the table going, why are we doing this? This isn't the right thing. Like that's just going to be more annoying than anything.
No, I think that absolutely makes sense. And I think it's having like I don't know if the right idea, but maybe like timing is a big part of it. Having a strong founder also important. But I'm just going to change it a little bit. This is the last question I'll ask, and then I'll start kind of asking questions from the audience. And this is something that I'm constantly thinking about as I'm speaking to founders. I think there's there's this sexiness around like VC funding, and everyone wants to have access to VC funding, but sometimes that's not the best kind of funding, and it doesn't work for everyone, right? And like I think SheWorx parent company Republic really leverages the crowd, like sourcing both in an equity and debt instruments kind of platform. So how should founders think about the types of funding that's right for them and their business model, and what should they be doing before they even start the fundraising process?
So venture capital is a very unique type of funding. And I think the thing that people have to be most conscious of is that it is risk capital. It is the kind of capital where it is meant for somebody to take a swing for the fences, which also means that the outcomes could be very large, but the downside is a zero. And, if you do not have tolerance for a 0, you probably shouldn't take venture capital funding. And so, I recently, last year, a company that I'm very fond of and that I was an investor in, and I'm so glad they're still around, Ample Hills Creamery in New York, which is a business, built by two founders, Brian and Jackie, who, sort of a mom and pop shop who went to go strike it big, raised venture capital dollars. We did a whole bunch of things at once. We built a factory and all of that sort of stuff, and just turned out to be a very complex business. We ran into some difficulties. Ultimately, they wound up filing for bankruptcy, and the group that bought it out of bankruptcy decided to run it out of on their own. So those founders are no longer part of that business, and it's heartbreaking to me. Like, it's obviously it's way more heartbreaking for them, but I cannot walk by a location without thinking like, man, that's rough that they started this thing and they're not a part of it anymore, partly because they raised venture funding. They wanted the upside, but I think if I were to go back in time and said to them, can you imagine not running this business? And if you have to be okay with that risk, and I don't know if we really fully thought that through in the beginning. Like, I knew that I was okay with it because I'm investing in a portfolio of 30 companies, and I know that not any one company is sort of make or break. But as a founder, that's a really difficult thing, and you have to be willing to sort of take that kind of risk if you're taking sort of the venture capital money. I think second to that is this is why I also think that financial modeling is really important. Look, no one ever gets it right. Like, no one ever predicts it perfectly. Sometimes you way underestimate what the company could do, and sometimes you way overestimate it. I think it's important to sort of think through, what do you think will happen over the next couple of years? What kind of money do you need? And I think too often people try to raise, they make a couple of mistakes. They try and raise what they think they can raise versus what the company needs. And then they get halfway to nowhere. And then, or they try and raise a whole bunch more, and there's a version of it that is maybe incremental that would make their pitch a lot easier. So I was just talking to a couple of people the other day, and they were like trying to raise $2 or $3 million. And I was like, the first 250K in this deal would make a huge difference in this pitch. And like, could you gather something smaller to make the pitch that much better, to go from product or not product, or to expand the team or get that first customer or whatever. I think you got to really think about, what can you accomplish with what kind of money at different stages.
Yeah, and I think that like one thing also, just like having the opportunity to have worked for a VC and now working for one, is understanding the economics of like where the fund is at too, and how that's going to impact you as someone who has who is taken capital from the fund. So now some questions from the audience. Really excited. I actually really like this one. So being a generalist investor, you've invested in different verticals along the years. So based on your past experiences, what are the top 2 verticals in 2021 and 2022? And what are the verticals that you can say are saturated?
I always find the verticals and the industry sectors as a question to be kind of a head scratcher, because like, I don't know what someone would do depending on my answer. Like, if you're really passionate about kids things, and I'm like, oh, kids is so overdone, well, then I'm just not the right investor for you. And if you're, you could have the most amazing idea in that space. So like, don't change what you're doing or try and start a company in the next hot thing because I said so, or because VCs said so. Now, if you're an investor, I mean, maybe that's sort of a different story. Look, I would say that all of these companies and the successes are exceptional. And what I mean by that is like, they are by exception. They are the things that buck the trend, right? They are the things that, despite the fact that there are a whole bunch of other people doing it, or what have you, that they still are able to kind of make it. So for as much as I would say things are, could be saturated, I think there's always room for improvement. The one thing that I would say where there are areas that I find a little difficult is retail models where you're basically just selling other people's stuff, and you don't have a hack for improving the economics of that model, right? You don't have some special pipeline to to customers. So for example, like, look, for example, Zola, the wedding registry website, sells other people's stuff, but they have to acquire the bride and groom, or brides and whoever's getting married, partners, all of that sort of stuff. And then they bring everybody else along. So in some way, their customer acquisition cost is way lower, because I did most of the customer acquisition by telling everyone, where my Zola registry was. So that's a hack for a much better business model. And the time between when somebody buys and then when somebody actually gets the stuff delivered is very long. And so they also get to keep the float. So, I invite you to my wedding in June, you buy a gift in April, we're moving into a new apartment in September. They're just sitting on that money for 6 months, just, collecting interest and all of that sort of stuff. And so that's a really neat improvement on the regular retail selling other people's stuff business model. So those are the types of things that that make that a little better.
That makes a lot of sense. And so this question has come in a couple of times in different iterations. So I think it's important to ask. But what do you look for in a company that is pre-revenue?
Yeah. So I think there are a lot of instances where just getting to revenue in and of itself is not necessarily proof. There are many instances where, for example, I tell people, hey, that's a business, but I'm not sure that it's a big business, right? Or like, yeah, I would pay a little bit of money for that as a consumer, but I'm not sure I would pay a lot for that, right? And then they come back to me 6 months later and they're like, hey, we got way more consumers. And I'm like, yeah, but that's not the thing I had an issue with. My issue was the check size, the annual contract value. Like I was sure you could get a bunch of people paying, but I wasn't sure that you could get people paying a lot, and you still haven't proven that, right? So some people, like, revenue comes in many different flavors and shapes and perspectives and all of that sort of stuff. So revenue is not binary. It's not like, yes, I have it, or no, I don't. So I think like just getting to any revenue whatsoever is not enough of a signal. So if you don't have revenue, I would say, are there, people explain it in sort of a couple of different ways. Look, one is you're looking for somebody who is just as interested in the problem, and what you're really doing is pitching the problem and pitching your version of the solution. And sometimes it's just like agreement that the solution exists. Other times you're pitching the cost of not having that solution. So for example, somebody pitched me on a version of getting medical help. And part of what they were pitching was like, for those of us that either don't have healthcare or have a high deductible plan, you show up at the doctor, it's like 150, 200 bucks just to show up, right? So what you're really pitching is the fact that, like, there's a level of service that doesn't require being paid $200. So if you can do something like that, where you're like, oh, wow, I could get that done for me for $10, $20, $50, like, I don't necessarily need revenue as a proof, because the alternative is paying $180 to go for a visit. So the more you sort of talk about the problem and the alternative, I think that's key. I think the other thing is to go back to the homework thing is, when somebody comes to me and says, I was the buyer previously, and there is no solution for this, and let me tell you about the way we had to hack a solution for this, and this is terrible, and if anybody was able to do this, we'd buy it in a heartbeat. Like, when someone really comes from that buyer's perspective and understands the buyer, that can be very powerful. There's also various things like pre-sales or various types of signups. One quick example, and it's unfortunate because they just wound up shutting down the service, but it was a decently successful exit. Bank Simple, simple.com. They had a bunch of people sign up for their banking services before launch and agreed to put down a deposit based on all of the pre-marketing that they did. The number of people, and it was like tens of thousands of people who were willing to do that, was so large that they got a fair amount of financing before they even took $1 in deposits day one. So there's ways that you can kind of hack having customers before actually having customers, or show interest and engagement.
I love that. I also had not thought of how much money that you're potentially saving a customer instead of how much money you're generating. And so we are down to the last couple of minutes, and I'm really excited to close with this question. And I have seen this. You and I have like mutual friends who also just like vouch for you and really see you as an ally. And I think you've shown that with your work and where you invest your money. And so, on investing in underestimated founders and amplifying diverse voices, I think you've made a really big effort to amplify diverse voices through either the events series that you have, and as an ally. What do you do to ensure that underestimated founders participate in these conversations from a place of power and strength and confidence? And how do you get away from your own biases that exist?
I think the latter half of that question is more important, because like, I don't like allyship to me is a strange way of putting it, because I sort of think like what is the alternative? Like if you weren't an ally to just all of the other humans around you, then you're kind of a jerk. Like, I just, I don't want to be a jerk. So let's like, I think if we all woke up every day and just thought to ourselves, like, how do I not be a jerk today? I think the world would be, sort of a better place. And there are ways in which we're unintentionally and maybe accidentally jerks through, you know, in some ways, willful ignorance or refusal to be self-aware. So I think the number one thing for me, I think, is just being really intentional about my network and not letting my network just be who happened to show up, right? And being really intentional about like what makes people show up for certain things versus not. So for example, it is more likely the case that female founders or founders of color will feel like they don't have enough to pitch. And so that being the case, if you sort of put out there, hey, open pitch event, right? You're probably going to get majority straight white dudes who feel like, oh, I've got something that's worth pitching, right? And they'll just show up and they'll pitch and they'll kind of dominate the thing, right? If you show up and say, I have a feedback forum for early stage founders who are looking for feedback sort of before they pitch you're going to get a really much more diverse crowd. And the funny thing is, they're not actually that much more early stage than the other group of people, right? They may think they are, but they're not. But if you change the nature of that exchange and the kinds of asks that you're making, it does a lot to sort of diversify that base. I think the second thing is also interpreting how people pitch. I've noticed a lot of differences in comfortability with projections, forecasts, thinking about the future, how much people ask for on a pitch, right? And, you know, an all straight white male team will have no problem asking for $2 million so that they can get to $100 million in annual revenue in 7 years. And that's just every pitch, you know, one after another after another. Is it likely that they will get to $100 million? No. I mean, statistically, it's likely they go out of business, right? But is it possible? Yes, it's possible. And that's what VCs do. We invest in possibility. And so I think there's a lot of female founders and founders of color that don't make that switch to pitch what's possible. They pitch what's most likely. And that is going to seem smaller. It's going to seem less ambitious. And I think it's important for me that I've learned to, like, I flip the question a lot. You know, if somebody pitches it, hey, this is how we get to break even, this is all we need, or whatever. I think it's important for every straight white male VC to ask questions like, if you raised $1 million, would you know what to do with it? If you raised $2 million, would you know? Tell me how you would put that amount of money to work. So instead of just saying, what are you pitching for? Tell me how you would pitch, you know, put more money to work, because they might answer in a way that's like, wow, that's a much better plan. We should do that. Like, why are you only raising 380K? Oh, because that's the exact amount of money I need to break even. And it probably is, but that $1.5 million plan might be a better plan. Or ask questions like, do you think this thing could get to $100 million in revs? Like, and I have never heard more confidence than when I hear, you know, female founders of color going, oh yeah, of course, 100. This could be, you know, way more than that, right? And it's like, why isn't that in your deck? That needs to be in your deck, because I'm investing in possibility here. Well, that's not probably what's going to happen. It's like, no, probably you're going to go out of business and this is going to be a flame out. Like, that's the way most of these things work. But your deck's got to be about possibility, and you have to own that and not get caught up in the what ifs and all the things get wrong, because it's not a promise. You're not going to owe anybody venture capital money if in fact you run out of it. It's not something that people have to worry about.
That's beautiful. So a lot of it's just like recreating the frameworks that you've used, and then also kind of like how you're framing questions, and you have a completely different output. And Charlie, thank you so much for your time, for your kindness, for your insight and your thoughtfulness. And this has just been such a great conversation. And thank everyone. I thank you all for joining us. I know that we have folks from all over the world. I saw some people from Tampa. I think I saw some folks from Mexico, folks from New York. It was such a pleasure to just like have a conversation with y'all this afternoon.
Hey, I'll throw out one thing, because there are a couple of people that are asking, like, how do I get in touch and all of that sort of stuff. I am on Twitter. It's CEO NYC. If you just like have questions that you want to follow up with and kind of get answers, it's probably an easy way to get quick answers versus like email or something like that. If you're actually pitching and you're in the New York area and you have yet to raise 750K, that's my criteria. So I want to be part of the first money or earliest money that goes into the company. My website is brooklynbridge.vc. There's a little calendar request tool. It's probably the way that most people start out. My email address is there as well. LinkedIn's not a great way to get in touch with me, and I'm not likely to accept your LinkedIn invite if I don't know you, because then I'm giving my whole network access to you, or you access to them. So, I like to know who I'm adding into my network a little bit on on those types of platforms. But Twitter and my website's probably the two best ways to have initial contact. And I'm happy to follow up with some of the questions we didn't get to here.